Friends, thank you for being here today. What if I told you that the very financial institutions publicly championing American economic interests have spent the last few years quietly financing the rise of America's greatest geopolitical rival? And what if the political theater of trade wars, tariffs, and tough rhetoric was not a strategy for victory, but a distraction designed to conceal the largest capital transfer in modern history? These questions are not hypothetical exercises in conspiracy theory. They are the gateway to understanding the harsh mathematical reality of our current economic moment. To the casual observer, the years between 2018 and 2020 represented a peak in American nationalism and economic protectionism. We saw headlines screaming about standing up to Beijing. We heard politicians from both sides of the aisle uniting in a rare consensus to bring jobs back home and punish unfair trade practices. Yet, if we look past the curtain of political performance and examine the ledger of global finance, we see a completely different story. We see a mechanism that has repeated itself for over 300 years, a mechanism that signals the end of one empire and the rise of another. Today, we're going to explore this mechanism, trace its historical path through Britain, Germany, and the United States, and confront the uncomfortable truth about where we stand right now. To understand the gravity of our situation, we must first examine the great paradox of the years between 2018 and 2020. The narrative sold to the American public was clear: the United States was finally fighting back. On July 6, 2018, the Trump administration imposed the first significant tariffs on Chinese goods, igniting a trade war that would dominate the news cycle for years. We were told that supply chains were being decoupled, that manufacturing was being reshored, and that the era of blindly funding our strategic adversary was over. The media landscape was saturated with images of economic conflict, creating a psychological reality for the American voter that the country was engaged in a fierce struggle for economic dominance. However, financial data from that exact period reveals a starkly contradictory reality. Between 2018 and 2020, while the rhetoric was hottest, Wall Street's giants, BlackRock, JP Goldman Sachs, and others, orchestrated the movement of approximately $1.4 trillion into Chinese markets. This was not a trickle of speculative cash, it was a flood of institutional capital. In 2020, the very year the trade war rhetoric reached its zenith and the global pandemic strained relations to the breaking point, this capital flight hit its absolute peak. Consider the actions of the major players. BlackRock, the world's largest asset manager, aggressively expanded its Chinese operations during this period, urging investors to increase their exposure to Chinese assets. JP sought and received approval for the first fully foreign-owned securities business in China. Goldman Sachs ramped up its stakes in joint ventures on the mainland. If the political narrative were true, that the U.S. was decoupling from China, these moves would represent a catastrophic failure of risk management. Why would the smartest money in the world pour trillions into a country that the U.S. government was supposedly trying to isolate? I want to pause here for a moment and ask you, what do you think is the real motivation behind this contradiction? Do you believe these institutions are simply hedging their bets, or do you think they know something about the future of the dollar that the general public does not? Please pause the video and let me know your thoughts in the comments below. The answer is that they were not making a mistake. They were executing a plan. This paradox, the divergence between what politicians say and what money does, is the first signal that we are witnessing a historical phenomenon known as the capital shift. This move was predictable, calculated, and consistent with the behavior of financial elites in every collapsing empire for the last 3 centuries. To understand why this is happening, we must look beyond the daily news cycle and understand the underlying mechanics of the system. This leads us directly to the engine that drives these events, the 4-stage cycle of reserve currencies. The global economy does not run on chaos, it runs on a cycle. This cycle is driven by the life cycle of the global reserve currency, the dominant form of money used for international trade and savings. History shows us that no reserve currency lasts forever. From the Dutch guilder to the British pound to the US dollar, the system follows a precise 4-stage deterioration process. Stage 1 is the establishment phase. In this stage, financial elites create a monopoly on money printing, usually through the formation of a central bank. This centralizes financial power and allows for the coordinated expansion of credit. Stage 2 is the expansion phase. The monopoly on money creation is used to finance government growth, military conquest, and imperial expansion through debt. During this phase, everything looks fantastic. The economy booms, the empire expands its borders or influence, and the standard of living rises. The population believes they have cracked the code to perpetual prosperity. Stage 3 is the overextension phase. This is the turning point. The system becomes bloated. The cost of maintaining the empire, military bases, social programs, bureaucracy, exceeds the productive capacity of the economy. To keep the machine running, the government and central bank must print more and more currency. The currency begins to lose value, inflation ticks up, and the government starts losing control. Cracks appear in the social fabric as the discrepancy between the financial economy, stock markets, and the real economy, wages and production, grows. Stage 4 is the transfer phase. This is the most critical and least understood part of the cycle. As the collapse becomes inevitable to those who understand the math, the architects of the system, the banking families, the institutional investors, the smart money, do not go down with the ship. Instead, they move their capital to the next rising power before the collapse is obvious to the general public. They restructure their wealth into the assets of the ascending nation, leaving the domestic population of the dying empire holding the worthless paper currency. We are currently in stage 4. To prove this is not alarmism, we need only look at the historical record. The blueprint has been followed before. Let us look back at the British Empire, which provides the perfect historical blueprint for this modern collapse. The story of the British Empire offers a chilling parallel to the American experience. Stage 1 began in 1694 with the creation of the Bank of England. A Scotsman named William Paterson proposed a solution to Britain's financial woes during its war with France, a bank that would loan the government money at interest, backed by the government's ability to tax. This allowed the state to monetize its debt, turning government obligations into circulating currency. Stage 2 kicked in immediately. Britain's national debt exploded from 1.2 million to 16 million in just 4 years. By 1815, after financing the Napoleonic Wars through continuous borrowing and printing, the debt hit $885 million. Did this destroy Britain? No, initially it fueled it. This massive injection of liquidity allowed Britain to build the world's largest navy, colonize half the planet, and establish the pound sterling as the undisputed global reserve currency. For a century, the world ran on pounds. But by the mid-1800s, stage 3 arrived. Britain's industrial dominance began to wane as Germany and America industrialized. The cost of maintaining a global empire, garrisons in India, fleets in the Atlantic, bureaucracy in Africa, grew faster than the British economy could sustain. The debt began to climb again, not for productive investment, but for maintenance. Then came stage 4. As the 20th century approached, the British financial elite saw the writing on the wall. They realized that the British engine was running out of steam. Quietly, British capital began to flood across the Atlantic. The same institutions that built the British Empire started pouring money into American railroads, American steel mills, and American factories. The House of Rothschild and other banking dynasties financed the industrialization of the United States. By the time Britain was forced to abandon the gold standard in 1931, signaling the end of the pound's reign, the transfer was already complete. The financial system had been cloned and transplanted to New York. The British public was left with a devalued currency and a crumbling empire, while the architects of the system retained their wealth and influence in the new power center. They moved the money before the collapse. If Britain shows us the slow decline, the example of Weimar Germany reveals the weaponization of inflation. The example of Weimar Germany in the 1920s provides a darker, more rapid example of this mechanism, highlighting how intentional currency destruction can be. After World War I, the Treaty of Versailles slapped Germany with a reparations bill of 132 billion gold marks. This was a debt that could never be repaid through honest production. The Weimar government faced a binary choice: impose crushing austerity and taxes on its own people to pay foreign powers, or print money. They chose the printing press. This was stage 2 and 3 compressed into a few years. The Reichsbank, Germany's central bank, began monetizing government debt on an industrial scale. They printed money to pay striking workers in the Ruhr Valley, to fund social programs, and to keep the fragile political coalition together. The result was the most famous hyperinflation in history. In early 1923, you could buy a loaf of bread for a few hundred marks. By November 1923, that same loaf cost billions, then trillions. The money supply went from 8.6 billion marks in May to 400 quintillion by November. $1 was eventually worth 4.2 trillion marks. The human cost was devastating. The German middle class, which had been the backbone of the nation, saw their life savings evaporate overnight. A lifetime of work was reduced to 0. Workers had to be paid daily, then hourly, rushing to buy goods before their wages lost value. However, historical records, including the diaries of Reichsbank President Rudolf Havenstein, suggest this was not merely incompetence. It was policy. The hyperinflation allowed Germany to wipe out its domestic war. Debts, which were denominated in marks, effectively resetting the government's ledger at the expense of its citizens. Crucially, stage 4 appeared here as well. As the mark collapsed, foreign capital, specifically American capital, swooped in to restructure the German economy. The Dawes Plan of 1924 brought Wall Street into Germany. American banks gained massive ownership stakes in German industry at fire sale prices. The collapse of the currency facilitated a transfer of ownership from the domestic middle class to international financial interests. Now, we must turn our gaze to the current global hegemon, the United States and the sunset of the Bretton Woods era. The modern financial order was born in 1944 at Bretton Woods, New Hampshire. The United States, holding the vast majority of the world's gold, established the dollar as the global reserve currency, pegged to gold at $35 an ounce. Every other currency was pegged to the dollar. It was a promise. The dollar is as good as gold. For 2 decades, this system worked. But in the 1960s, the U.S. began to violate the math. Under President Lyndon B. Johnson, the U.S. embarked on a guns and butter policy, fighting the Vietnam War while simultaneously building the Great Society welfare state. The U.S. did not raise taxes to pay for this. It printed money. By the late 1960s, there were far more dollars circulating globally than there was gold in Fort Knox to back them. Foreign nations noticed. France, under Charles de Gaulle, called the bluff and began demanding physical gold in exchange for their dollar reserves. Britain followed suit. On August 15, 1971, President Richard Nixon went on television and announced the temporary suspension of the dollar's convertibility into gold. The gold window was closed. Stage 3 had fully arrived. The dollar became a pure fiat currency, backed by nothing but government decree. Since that day, the dollar has lost over 98% of its purchasing power relative to gold. Gold has moved from $35 an ounce to over $2,500 an ounce. This is not gold getting more expensive. This is the dollar dying. The system was patched together through the petrodollar agreement, forcing the world to buy oil in dollars. But the fundamental rot remained. The debt continued to grow. The printing continued to accelerate. And now we are reaching the mathematical limit. This historical context provides the necessary lens to see the current execution, the massive capital transfer to China. This context is essential to understanding why BlackRock and others moved $1.4 trillion to China between 2018 and 2020. We are watching Stage 4 execute in real time. The trigger for this massive acceleration was not a random market fluctuation. It was a structural change in the financial plumbing. On June 1st, 2018, just 1 month before Trump's tariffs went into effect, MSCI, Morgan Stanley Capital International, officially included Chinese A-shares in its emerging markets index. This sounds technical, but its impact was seismic. Trillions of dollars in global capital, pension funds, 401ks, sovereign wealth funds, are passively managed. They are mandated by their charters to track these indices. When MSCI added China to the index, it forced these funds to sell Western assets and buy Chinese assets. It created an automatic, relentless pipeline of capital flowing from the west to the east. While politicians argued about tariffs on washing machines and steel, the financial plumbing was rewired to send the savings of American workers into the Chinese stock market. China's weight in the index skyrocketed from near 0 to 43% in roughly 2 years. The trade war provided the perfect cover. It focused the public's anger and attention on the surface-level conflict, while the structural integration accelerated largely unnoticed. Let us look at the scoreboard for the United States today. We have a national debt exceeding $34 trillion. Our debt-to-GDP ratio is near 100%, and arguably much higher if unfunded liabilities are included. The Federal Reserve's balance sheet exploded from under $1 trillion in 2008 to over $7 trillion today. We have monetized debt at a rate that would make the Weimar Republic blush simply over a longer time frame. The system is overextended. The currency is being debased to keep the debt serviceable. And just like the British bankers in the 1890s and the American bankers in the 1920s, the modern financial elite are positioning themselves for the next reality. They are not loyal to a flag. They are loyal to capital preservation and growth. They see that the U.S. is in the late stages of the debt cycle, and they see China, despite its own issues, as the rising center of gravity for the next century's economy. To understand why the public remains passive in the face of this theft, we must examine the illusion of prosperity known as the crack-up boom. You might be asking yourself, if the system is truly collapsing, why does my 401k look so healthy? Why are home prices at all-time highs? Why does the GDP continue to print positive numbers and the news anchors tell us the economy is resilient? This phenomenon is perhaps the most insidious feature of the transition from Stage 3 to Stage 4. The collapse does not initially look like a depression. It looks like a boom. Austrian economist Ludwig von Mises famously described this terminal phase of a fiat currency as the crack-up boom. It is a period where the desire to hold real assets outweighs the desire to hold a depreciating currency, causing nominal prices to skyrocket. The mechanism behind this illusion is known as the Cantillon effect. When the Federal Reserve floods the system with trillions of dollars to monetize the debt, that money does not flow evenly or instantly into the economy. It enters at the top. It flows first to the primary dealer banks, the hedge funds, the private equity giants, and the corporations with direct lines to the credit window. These institutions do not use this free, newly printed money to buy groceries or pay rent. They use it to speculate. They buy stocks, they buy real estate, they buy bonds, and they engage in stock buybacks. This massive wave of liquidity pushes asset prices to the moon. To the average citizen looking at the S&P 500 chart or their Zillow home estimate, it appears that wealth is being created. They feel richer. They see their net worth on paper hitting record highs and assume the economy is roaring. They confuse the fever with the cure, but this is a mirage. The numbers are going up not because the assets are becoming more intrinsically valuable, but because the currency being used to price them is becoming worthless. In Weimar Germany, the stock market didn't just go up, it soared into the stratosphere during the hyperinflation. A German investor who stayed in stocks nominally made trillions of marks, but when those trillions were converted back to purchasing power, to bread, to coal, to shoes, they found they had actually lost everything. The gains were merely a reflection of the currency's death spiral. We are seeing the exact same phenomenon today. The wealth created in the last decade is largely a monetary illusion. When the price of a standard suburban house doubles in 10 years, but the house itself hasn't changed, it hasn't gotten bigger, the land hasn't expanded, the location hasn't moved, that isn't appreciation. That is devaluation. The house is the constant. The dollar is the variable. The house acts as a mirror reflecting the eroding value of the cash in your wallet. This illusion serves a vital strategic purpose for the financial elite. It acts as an anesthetic for the public. If the collapse were deflationary, if wages fell, stocks crashed, and home prices plummeted, the population would immediately recognize the failure of the system. There would be panic, political instability, and potentially revolution. But by engineering an inflationary collapse, where nominal numbers go up while real purchasing power goes down, the architects of the system can keep the population sedated. The wealth effect of rising asset prices keeps the boomer generation and the middle class complacent, believing they are secure, while the purchasing power of their wages and pensions is quietly stolen by inflation. Meanwhile, the smart money sees through the illusion. They know that while nominal prices are rising, real yields are collapsing. They know that the U.S. stock market, when priced in gold rather than dollars, has actually been stagnant or declining for decades. They understand that staying in Western financial assets now is like picking up pennies in front of a steamroller. The gains are nominal, the risk is total. This explains the profound disconnect between the vibes of the economy, where regular people feel squeezed, anxious, and unable to keep up despite good macroeconomic data, and the official narrative. The official narrative points to the nominal highs. The public lives in the real lows. And it is precisely this confusion that buys the elites the time they need to exit. They need the retail investor to keep buying the top, to keep pouring their monthly 401k contributions into the S&P 500, providing the exit liquidity that allows the institutions to sell their positions and move that capital to the next safe haven, to China, to commodities, to hard assets. They are selling you the burning building and telling you it is a castle, pointing to the flames and calling them fireworks. Finally, we must confront the nature of this mechanism and, most importantly, what it means for you personally. We must understand that this mechanism is mathematical, not ideological. It does not care about American exceptionalism. It does not care about democracy versus authoritarianism. It operates on the cold logic of compound interest and debt dynamics. When a monetary system is based on debt, and the entity that creates the money is separate from the entity that taxes, the system must eventually consume itself. The debt grows until it cannot be paid. Then, the currency is sacrificed to save the bond market and the government. The disconnect we see today, where the stock market hits all-time highs while the average American struggles to buy groceries, is a symptom of this late-stage debasement. The inflation is not transitory. It is the deliberate policy required to manage a debt load that is mathematically unpayable. The political theater is a necessary part of this process. If the population understood that their currency was being actively destroyed and their nation's wealth was being transferred abroad, there would be revolution. So the narrative focuses on external enemies, partisan bickering, and culture wars. The trade war was theater. You cannot fight a nation while your own financial sector is funding its industrial rise. You cannot claim to be decoupling while your pension funds are increasing their allocation to the rivals' markets. The contradiction is the point. It is the smokescreen. So where does this leave us? It leaves us with the urgent need for recognition. The pattern is 3/4 complete. The transfer of wealth is not a future event. It is a current event. The $1.4 trillion that moved to China is just the vanguard. If you are holding your assets strictly in US dollars, or in standard diversified portfolios that are blindly following these indices, you are unknowingly participating in this transfer on the losing side. You are the British citizen holding pounds in 1930. You are the German worker holding marks in 1923. The next 5 to 10 years will not look like the last 30. The stability of the post-Cold War era is over. We are entering the volatile transition period of Stage 4. The debt will be defaulted on, either explicitly, which is political suicide, or implicitly through inflation, which is the historical norm. The purchasing power of the dollar will continue to erode as the government prints to cover its liabilities. But unlike the citizens of the past, we have the advantage of information. We can see the pattern. We have the data. We know that when BlackRock and the titans of Wall Street move, they move with a purpose. They have signaled their bet. They are betting on the end of the dollar hegemony and the rise of a multipolar financial order centered in the East. If you are finding value in this analysis and want to see more content dissecting these financial mechanisms, please take a moment to like this video and subscribe to the channel. It helps us get this information out to those who need it most. You do not have to agree with their morality to respect their foresight. The machine is in motion. The only question remaining is whether you will watch the political puppet show and be left holding the bag, or whether you will recognize the mechanism, understand the history, and position yourself to survive the transition. The choice ultimately is yours. But do not say you were not warned. The capital has moved, the cycle is turning, and the clock is ticking.